Great. Well, hello, everyone. My name is Krian Butler, and I'm the Director of the Global Economy and Finance Program at Chatham House. And on behalf of Fathom Consulting and Chatham House, it's a great pleasure to welcome you to this afternoon's discussion on what's next for UK monetary policy. And we've timed this, as I'm sure you can see, to follow yesterday's MPC meeting. This is a new departure for Chatham House, I think. I've only been here 2 years, but I think in two respects. Firstly, in the sense that this session will have quite a strong domestic UK economic focus. And we typically, events here have a more international flavour. However, we felt that the last couple of months, particularly 23rd of September and what's coming shortly, has had really quite considerable international significance. And I came back from Japan yesterday, and it was amazing how everybody was talking about this one way or another. Now, it may well be that this is not in terms of spillovers, more in terms of demonstration effect, but it just seemed important for us that we should cover this here. And the second thing is that before we get into the panel discussion, we're going to have a serious economic forecast or presentation outlook from Fathom, and I'm extremely grateful to Eric and his team for putting that together. But I think that's going to be very good context for the discussion that we're going to have. Just a reminder of the sequence. So first of all, Eric and Laura from Fathom will do the presentation of their latest outlook. We'll then move to the panel discussion with former members of the Monetary Policy Committee and Fathom's chief economist. We'll have presentations from the panelists and then a debate. And after that, we'll open it up to questions from the audience. And we're also going to sprinkle throughout the event a number of survey questions. And we'll have those done by Sligo, which I'm very confident our experts here will make happen very smoothly. So we'll have some survey questions as well. I should note that this event is on the record. And as well as the in-person audience here, we have an online audience as well. And that's drawn from Fathom's contacts and also Chatham House contacts and members. And also, if I could ask you to, when we get to the discussion, to try and keep your questions and comments as succinct as possible, because we have a hard stop at 5:30, which I think is slightly shorter than sometimes these events have been. So first to the Outlook presentation. This is going to be given by Eric Britton, who, well known to a great many of you, is CEO of Fathom Consulting. Previously had a very distinguished career in economic consulting and at the Bank of England working in the monetary analysis area on the inflation forecast. And he's going to be joined by Laura Eaton, who's the Chief Operating Officer at Fathom. She's an expert model builder. I'm absolutely fascinated because she does quite a lot of model building on the Chinese economy, which must be quite a challenge, but nonetheless very important to do. So Eric and Laura, over to you for your presentation.
Thank you very much. Thanks, Krian, and welcome everybody. Wonderful to be in person with an actual live audience of people and those who are joining us virtually too. You enjoying the ride so far? The last few weeks? It's fun, right? Spent many years. We had this monetary policy forum starting in 2009 in the teeth of the financial crisis back then, and we ran it for 10 years quarterly after 2009, during which they moved interest rates. Not once. 10 years of quarterly sessions. What are they going to do with rates at the Bank of England? Nothing again, nothing. And it got to be a little bit dry towards the end of that. Well, it's not dry anymore, that's for sure. So here we are, we're talking about this. Let me welcome Laura to the stage, who's going to be sharing this presentation with me. It's wonderful to be here at Chatham House, and thank you so much, Krian, and everybody else involved from Chatham to make this happen. Right. Emergency Monetary Policy Forum, emergency for reasons that I'm sure are obvious to everybody. I'm hoping this clicker will work. Over to you, Laura.
Yeah, so thank you for coming today. So Fathom is predicting a recession everywhere, is the gloomy picture that I'll begin with. The top right charts here, you can see the gold dots is consensus, and Fathom's projection for both the US and Euro area GDP growth is below that. The green line is our central projection. So The differentiation is going to be across economies in terms of GDP growth, which is the next chart, which looks at terms of trade. So this is export prices relative to import prices. And you can see the green line here is the US, which is standing out to be much higher than everyone else that's dropping. And the reason for that is that the strength in the dollar, due to the safe haven assets, is reduced import prices for the US consumer. And then also it's a net energy exporter and has obviously benefited from energy prices rising so much. So we see the US is going to be faring much better than some other economies in the near-term future. Contrasting that to China, the bottom right chart, there's a large downward skew in our projections for GDP growth, and that's owing to our 15% probability of it entering a banking crisis in the next few years or so. Taking a step back, we've just had the steepest recession of all time, followed by the steepest recovery of all time due to monetary and fiscal loosening. So having this pause in growth is to some degree to be expected. The question is, how large is that pause in growth going to be? So generally, you can always find someone worse off than yourself, and normally that person, sorry Andrea, is Italy. However, in this case, unfortunately, it does appear to be the UK.
And it's easy to blame the budget for the current malaises in the UK economy. Very easy to do that, so let's go right ahead and do it. This is what's known, the term the moron premium is attributable not to me, but to Dario Perkins, I believe. And it captures the effect that the budget, the mini-budget announced by Kwasi Kwarteng, the Truss government, had on financial markets, that you can see very clearly there in the spread between UK 30-year index-linked yields and the US counterpart. They're just rocketing up. We'd never seen movements like that for decades, really, in those relative positions. And it's not just in the gilt market, it's also in the value of sterling. Basically, all sterling-denominated assets were revalued rapidly as a result of that budget. Sterling tanking. Back in 2019, we at Fathom put together a bunch of scenarios that assessed what the possible market reaction to a Corbyn government would have been at that time. And it turns out markets in the past have driven Labour governments off course within the space of a few weeks, a couple of months, by a very strong reaction to the proposed policies that those governments have announced. We looked at the one in the mid-1970s, the Wilson-Lib-Lab Pact of '74, and the impact that markets had in that time. And we thought that in 2019, the markets might respond in a similar way to a Corbyn government. And if they did, that would have been the magnitude. One Corbyn, let's call it, on the spread in the linkers market, and one Corbyn on the value of sterling. We thought this was a market reaction that would correspond to a far left Labour government, or just a left Labour government of any sort. In fact, half of one Corbyn has transpired as a result of a Conservative government, the budget announced by Kwasi Kwarteng. Half was enough, it transpired. Half of a Corbyn was sufficient to drive that budget off the rails. The budget, all of the measures in that budget have subsequently been reversed, and it's now in tatters as a result, which is exactly what we thought would happen to a Corbyn government. At the time we did those Corbyn scenarios, we were told there's no way markets would behave in that way. There's no way they would react that strongly, but they've done it now with a Tory government, or at least half as much. It's easy to blame the malaise of the UK economy on the budget, on the Truss government, on Kwasi Kwarteng. It's easy, but
instead, we prefer to refer to Truss as the straw that broke the camel's back. So you should also focus on what was overburdening that camel before she came into power. So thinking about the top right chart, the dark blue line, and casting our mind back to the Monetary Policy Forum that took place in February 2009, where the panel that you'll see later was calling for unconventional monetary policy, i.e. QE. At the time, I hear that Deanne said that QE could be likened to an affair. It's very easy to get into, but very difficult to get out of. To which Charles responded that maybe she was getting into the wrong types of affairs. So I'll let them debate that later. But in terms of QE, Deanne appears to have been correct. So 2009 QE, then again in 2012, the euro area crisis, and then QE on steroids in response to the pandemic. 2020. Monetary financing, direct lending from the Bank of England to the government, and at a much larger scale than was introduced in 2009 in response to the global financial crisis. Why did they do that? Well, the bottom chart, thinking about steepest recession of all time, including the world wars, including the Spanish flu and also the plagues. In response, private income rose, and that happened because of the large amount of government loosening that took place. Then, a couple of months ago, quantitative tightening was introduced. Vitally, this removed the put option for the investors and the market. So no longer were they saying, I will not let government bond prices fall. That was removed, and that was the context in which Truss announced her unfunded tax cuts, when the investors were watching for the fiscal sustainability of their plans.
Now you need to look at the fundamentals of fiscal policy again. The Bank of England had announced that to the world, and then they did the unfunded tax cuts in the budget, and that's why the markets freaked out to the extent that they did. Scrolling back a bit, it's not just that we're facing a recession now, it's not just that we've been through this convulsion related to the budget, it's also we're in double-digit inflation. And thinking about that inflationary environment, what's driven it? There's been a bunch of what's known as first-round effects out there that have contributed to it. The first one, captured on the top left chart there, is the shift into goods consumption. This is the share of consumer spending that goes on goods across a bunch of different countries over a long period of time. That trending down year after year after year, decade after decade, as we consume more services as a share of our overall basket. Reversing during the pandemic period. Why? Because we couldn't consume services. You're not allowed to travel, you're not allowed to go to restaurants and hospitality, etc. And the consequence of that, the share of goods increased. And it wasn't just the share, it was the absolute spending on goods increased everywhere, really quite dramatically, stretching global supply chains, causing the increases in shipping costs and a bunch of other things that we saw during the pandemic, and adding to the cost of living, really, for everybody around the world, including the UK. And then, as if that weren't enough, we had that nice Mr. Putin doing his thing in Ukraine, invading Ukraine, and the impact that that had on energy prices, especially gas prices, especially in Europe and in the UK, no less than elsewhere. All of these are first-round effects. They're going to drive the price level up, going to drive the cost of living up. Policymakers, monetary policymakers, correctly should look through the first-round effects and ignore them when it comes to setting interest rates. Think about the second-round effects. Is there any evidence that those first-round shocks are rippling through to wages, are starting to affect firms' prices who are not directly impacted by these things, are starting to feed through into other prices in the economy? That's the stuff that policy should be squeezing out. What is the second round? What about the second round? The bad news is there is pretty clear evidence of second round effects in most economies around the world, including in the UK. There's 4 charts here that give different perspectives on the same question. Top left chart there is the degree of pass-through from non-core consumer prices, which is the sort of volatile bits that move up rapidly, move down rapidly, into core consumer prices. So the non-core bits are the bits that pick up these first-round effects. Question is that rippling through to core consumer prices? Answer, yes. Across the OECD as a whole, that's the blue line, that degree of pass-through has increased dramatically. The US as well, the gold line. The UK, I would say the jury is out on this point. It's gone down, it's gone up again, it's gone down again. I would say the jury is out in the UK on that point. However, the jury is not out on wages in the labour market, which is the top right chart here. What we're looking at here is the blue bars of this are wage growth over a certain period, and the green bars are CPI inflation over the same period. Real wages are falling everywhere. That's not the point I'm making here. The point I'm making is nominal wages can only go up by the inflation target plus productivity growth, if they're not to be a source of inflation in the economy, capturing second-round effects. The inflation target's 2%, productivity growth in the UK, roughly 0. Anything for north of 2, therefore, is evidence of second-round effects in the labour market. It's pretty clear in the UK, in the US, less so, I would say, in Germany.
Fathom staff are pleased that it's higher than productivity growth.
Yeah, I mean, there's other factors in play there, which we'll come back to in a separate conversation, no doubt. The bottom left chart is a picture of wage-price correlations in the UK over a long period of time. And it turns out that if you've got inflation, CPI inflation, running at less than 5%, really, there's not much relationship between CPI inflation and wage inflation. But as soon as CPI inflation gets above 5%, you start to see this upward sloping relationship. It's quite loose, it's quite poorly defined. Where are we now is the green dot in that chart, which is in that range. We're above 5% on CPI, and we're starting to see it picking up along that upward sloping relationship, albeit towards the bottom of it. Evidence, I would say, of the beginning of a wage price spiral. We're not fully in one, but maybe there's evidence of it. And the final chart here is the degree of persistence in inflation. So to what degree is inflation now equal to inflation over the year up to now? And if that persistence is high, it's indicative that the credibility of the monetary target, 2%, is low. And there's a indication of a higher degree of second round effects in play in the economy. In the UK, it's all the way back up now to where it was in the 1970s. In the US, it's about half the way back to there. None of these charts is a slam dunk. Should be clear about that. You could have this degree of inflation persistence occur just because you've had a series of unfortunate events that push first round effects up over a staggered period of a couple of years. It would still look a bit like that. However, taking the whole panel together, I think we conclude anyway that there's pretty clear evidence of second round effects at play in the UK economy. The question is, the judgment for central banks is how much monetary tightening is needed to squeeze them out.
Enough to cause a recession. So you can see why we've arranged drinks afterwards. This is all quite gloomy so far. Inflation at current levels has almost always triggered a recession. The recessions in these charts are shown by the vertical grey bars. One school of thought says higher prices are naturally self-correcting thanks to their impact on real income and real profits. But as Eric's just shown, there is evidence, quite strong evidence, of second round effects. And so we believe that the Bank of England, amongst other central banks, are going to need to tighten more than they did yesterday. And therefore, that is going to result in a recession, particularly in the UK.
But quite likely in other countries too. It's not just the current recessionary environment we should be bothered about, though. We should be standing back and looking at the macro policy environment in the round for the last decade and more. And the news on that front, I would say, is very bleak. The headline says it all. Macro policy, in Fathom Consulting's view, over the last decade, really since the great financial crisis, maybe before, has been a disaster. And this tells you why. This is the growth in, the level of GDP on a log scale, so you can interpret the slopes of these lines as growth rates. The level of GDP in the UK is the blue line, and here's the great financial crisis, the recession that occurred there. We never recovered back to the pre-crisis trend, and furthermore, the trend post-crisis was slower than the pre-crisis trend was. This was growth rates like 2%, this was growth rates like 0.5 to 1% in the UK. Has to be said that that same shock occurred right across the G7, which is the green line there. And in Fathom's analysis, if you've been paying attention over the years, one of the big contributory factors to that reduction in trend growth post-GFC was the shift to permanently ultra-low monetary policy, permanently low interest rates, which stifles productivity growth for the reasons that I could go on about for an hour. I won't do so here. You'll be delighted to hear. Reduction in trend growth post-GFC and to a much weaker trend over that whole decade. Doesn't stop there. This is the pandemic period. What's the judgment that we should pass on the macro framework that was in place during the pandemic? Well, the impact on GDP in the UK was substantially worse than it was across the rest of the G7. The judgment, therefore, on those grounds alone was pretty bleak. There were other factors in the mix, of course, Brexit to name one, but notwithstanding that, just the impact of the pandemic itself on the level of GDP was much more pronounced in the UK than elsewhere in the G7. You might take that trade if you thought, well, I'm prepared to trade a worse econ outcome for a better health outcome. If the health outcomes in the UK were better than in the rest of the G7, you might say, fair enough. They weren't. They were worse than in the rest of the G7. Worse econ outcomes, worse health outcomes. The judgment of the government in charge, the macro policy environment in charge at that time has to be really pretty bleak. 2% trend growth, roughly. 0.5 to 1% trend growth, roughly. 0% trend growth, roughly. Roughly. We are overheating with growth at 0 in the UK. If that is not a damning indictment of the macro policy framework, I don't know what is. There has to be a better way than this. Please tell me there is.
Yeah,
Laura.
that's why we're here today, hopefully to find a better way. So in summary, top left, Fathom's forecasting a UK recession. Consensus has moved towards us on that point, and yesterday the Bank of England has too. Top right, we expect inflation to peak above 10%. Bottom left, we're going to need more interest rate hikes, maybe 6% over the next year or so. And that's going to push up the long end of the yield curve. How do we get out of this mess and do a better job in the future?
And this comes to a long run and piece of analysis that we've been doing over many years in Fathom. This is the relationship. I've cheated with the axes here, and apologies to Chris Giles if he's here. I know this is something that exercises a lot of people. The axes are not the same, so with that caveat in mind. But what we're looking at here is the real bank rate, the dark blue line, and the four-quarter growth rate in whole economy productivity, the green line. And there's lumps and bumps and wiggles and jiggles in all of this stuff. There always is. But broadly speaking, since the early 1990s, there's been a downtrend in both of those concepts. Growth slows, and we cut interest rates. We cut real interest rates. Growth slows again, and we cut them again. Growth slows again, and we cut them some more. We do this for decades. What point do we think, do you know what? Maybe cutting real interest rates doesn't just stimulate demand in the short run. Maybe it also undermines supply in the long run. And that's basically Fathom's perspective on this whole conundrum. We were in a similar environment to the one we're in now back in the 1970s. There was a decisive moment in British macro policy at the end of the 1970s, which is captured in that red oval there. Maybe we need another such decisive moment, a reset of the macro policy framework in the round in the UK. That's what we're calling for. That's what I think we need to think about in this session and beyond. That's it. Thank you very much.
Right. Well, there's a great deal to think about there. And what we're going to do to kick off with is actually have our first survey question. So I think the survey will appear, if we could do that. And the first survey question is, to what extent... We don't have it yet. Okay, maybe we'll have it very shortly. Right. To what extent has the MPC fulfilled its remit since the pandemic hit? And we are getting on...
on these screens, I'm afraid. I don't
okay.
know why that is, but somebody in the AP
So I'm not... It's possible it won't... So what we have done is put the survey to the online audience. I was assuming that we will get it here, but if we don't, not to worry, because I can certainly see the results coming up here. And so this will be an online view.
Yes,
you got it, okay. And it's still moving around a bit. So if you can, that would be great. Those who can. Okay, and still moving around a bit. Maybe we will... Oh. Okay, But why don't we freeze it there? So if we... No, you haven't voted yet. Okay. Okay, why don't we freeze it there? So if can we show the results? Yeah. So, very interesting. Very interesting. There we are.
Can you refresh us, Creon, as to what B and C were?
So I think they're the...
So that was to do QT and raise interest rates.
Yeah.
But the letters got dropped off.
Okay. So I think that's good to have a survey. And what we're going to do now is have a panel discussion with a really distinguished group of experts, 4 of whom are here in the audience and 1 of whom is online, and he's appeared now online. And the focus is going to be on a number of talking points, either through the initial comments or through the subsequent discussion. As is indicated from the survey we've just done, talking points to include to what extent has the MPC fulfilled its remit since the pandemic? And I guess, was the decision yesterday the right one to take? Will it be necessary for the bank rate to move above inflation to get inflation under control at some point in the coming 6 months or so? Why have even long-term interest rates risen so much? And this, I think, you can see from index-linked yields when you look further out. And I guess this is a way of asking to what extent has the Prime Minister Truss's policy experiments over the last 6 to 8 weeks or so are going to have long-term consequences. And then finally, just to add from a Chatham House perspective, what are the international implications of what the UK has been doing on monetary and fiscal policy, and both now but in the coming year. And so to respond to those talking points and also the presentation that we've seen, we're going to kick off first with some comments from Andrew Budgen, right at the end, Chief Economist at Fathom, and also a forecaster at the Bank of England, so along with many others in Fathom, the Bank of England background. So Andrew, over to you.
Thank you very much, Creon. I'm going to speak for a couple of minutes so we can give much more time to these other distinguished panellists. So I just want to draw out and emphasise 3 points really from the presentation. And the first one is that I think, we shouldn't, maybe with hindsight, but we shouldn't be surprised by double-digit inflation. It didn't come from nowhere. If you think analytically, what did we do during the pandemic? And I think it was completely the right thing to do. We asked the Bank of England, or the Bank of England decided independently to print a large amount of money. This money was transferred in the UK to workers who couldn't work. So we basically said, on condition you don't work, we're going to print some money and give it to you. Any kind of monetary economics textbook will tell you, if you print money and to pay it to people on condition they don't work, you're going to get inflation, and that's what we did. And also we said, oh, by the way, you can't spend it for a bit because all the things you enjoy doing are shut. So, of course, as soon as we opened the floodgates globally, all this money that had built up around the world was spent, and we got inflation. So, the plus side is we know helicopter money works. We're debating whether helicopter money could be used to get us out of deflation. Well, it can, if you do it powerfully enough. But then I think, in defence of the Bank of England in that situation, we weren't the only country doing this. The US was being the largest economy, was the largest contributor to this big build-up of cash around the world. So, even if the MPC had tried to tighten early last year, could they really have kept UK inflation under control if the Fed wasn't doing the same? I mean, yes, if sterling appreciated hugely, but that's perhaps unlikely. So, the Bank of England have got and had a difficult job. Second point I just want to talk about quickly is persistence. I think where we differ from the Bank of England and why we think interest rates could go up to 6% is that's the mean of a very wide distribution in our fan chart, is that we're much more concerned by second round effects than it appears the MPC are. They say it's something they're looking out for, something they're watching for. Well, can't you see it? I mean, I think there are very clear second round effects now. Our view is that in terms of inflation persistence, the extent to which inflation depends on what inflation was in the previous period rather than dropping back down to target, my view is that's gone kind of halfway back to what it was like before inflation targeting. And the risk is that it goes further still. And that's why we had such a wide fan chart for inflation. We just don't know, honestly, how persistent inflation is going to be. But I think that's why we differ from the Bank of England view. And perhaps also, the Bank of England is getting increasingly frustrated by market pricing for interest rates, trying to tell them you've got this wrong by several hundred basis points. And, and nothing happened yesterday. Market pricing for short-term interest rates hasn't changed. So maybe investors are kind of coming around to that view as well. I mean, we can perhaps debate later why investors are taking such a different view from the Bank of England. And then finally, the Bank of England is, I'm criticising them indirectly now. It's quite easy to criticise them. They have got a very difficult job. They're clearly aware that we're in a cost of living crisis. And, when I was studying economics many years ago, we were talking about the optimally conservative central banker. You wanted some nutter who cared only about inflation to get things under control. But, these are humans. These are nice people. They know there's a cost of living crisis, and then asking them to tighten aggressively and put mortgage rates up, it's a difficult decision. But they're independent perhaps, but they're human and they can see all the reaction in the press. So I guess from an inflation targeting point of view, my guess is there's going to be a natural tendency for them to hope for the best rather than take aggressive action. And I think hoping for the best was certainly what they were doing through much of 2021 until that became untenable, I guess.
Thank you very much. And certainly the TV yesterday was all about the consequences of this. It's quite striking how the media's focus is entirely in that area, perhaps understandably. So next, I'm very pleased to welcome William Bowter, who's online. William was one of the first members of the Monetary Policy Committee, an external member from 1997 to 2000. He's currently a senior fellow at the Council for Foreign Relations, previously chief economist at Citigroup and at the EBRD, and obviously also has a very wide-ranging academic career. So, Willem, over to you for your initial comments.
Thank you. It's a pleasure to have a chance to speak here. The MPC, the Bank of England, is behind the curve. I mean, policy rates are at 3% now, which is just into restrictive territory. We should have been in restrictive territory earlier and more aggressively. The same applies to the quantitative tightening, which has finally started. We're going to do 80 billion of quantitative tightening a year. At that rate, it will take 10 years to get rid of the APF that you build up. So it's very modest, but the tightening that's going on. They can't be blamed for all of the inflation outbreak. The MPC, like everyone else, was surprised by COVID, by the Ukraine war, and by the sanctions. This is unlike any shocks since the oil price shocks of the 1970s. And also, like most other central banks and many economic observers and analysts, they got the temporary and transitory nature of the supply shocks wrong. In the UK, for instance, the labour force participation rate is significantly lower than it was prior to COVID. That's a permanent supply shock. Activity rates have weakened. In addition, I think more gradual negative supply shocks driven by demographics, deglobalization, the bifurcation of the economy between the US-centered and the China-centered bloc, the cost of building up redundancy, moving from just-in-time to just-in-case, reshoring and onshoring, it does affect productivity growth. Brexit for the UK has been managed very badly. I think it was a disaster itself, but given that Brexit has occurred, the regulatory and fiscal changes to take advantage of whatever opportunities are there potentially has not been taken. And finally, I think the bank failed to recognize just the magnitude of the fiscal and monetary policy response to COVID and to the energy and commodity price shocks. So where will we have to go? I agree with the earlier speakers that bank rate will probably hit 6% in 2013. I do not follow the banks monetary policy report analysis where projecting current market interest expectations, which peak at 5.2 in 2023, we have inflation well below target at 1.1% by 2024, second quarter, and we had 0% in Q5. In fact, so in 2025 Q4. So similarly, the implausibility that of the projection that with 3% rates maintained throughout, we could actually get inflation back to target again. I think that's dreaming. So rates for 23 likely higher than markets currently project, but as a result of the recession, this will cause the rates could well be somewhat lower late in 2024 and 2025. Real interest rates, fiscal space. I'm one of those who believes that the 800 years of declining real interest rates have come to an end for most of the world. Demographic deglobalization and other supply side developments, weakening of ex ante private savings as a result of demographics. So I see the fiscal space is gone. Liz Truss and Kwasi Kwarteng's budget was insane and got punished by the markets. I hope the world learns from this and comes to the conclusion that R minus G negative is not going to be something that we can rely upon. I'll stop here.
Well, thank you very much. A lot of points I'm sure we'll want to come back to. But next I'd like to turn to Charles Goodhart. Charles was also one of the first members of the MPC, an external member. He's the Emeritus Professor of Banking and Finance at the LSE. And as almost everybody here will know, he was the author of Goodhart's Law and has had many other roles, including, actually, when I was at the bank, the bank's chief economic advisor. So, Charles, over to you.
Thank you, Crean. It's a great pleasure to be here at Chatham House, particularly since it's not going to be under Chatham House rules. I'm going to try and make 3 comments. The first one is that pushing up interest rates has a lot of nasty effects on the economy. Higher mortgage rates, declining employment, and so on and so on. And fairly soon into the process of raising interest rates, there's going to be more and more suggestions about, is there not another way to combat inflation? And that undoubtedly will tend to lead us back to wage and price controls. We tried that in the 70s and the 80s. We tried it to destruction, and it turned out to be pretty much a disaster. And some of that has been learned, but I think not all, because there is, I think, a growing danger that the form of wage price control that the present government may adopt is controls over public sector wages. And we've heard comments about the possibility of them to be held back down, not only this year, but next year, to numbers that are really quite extremely low. And if they try and go ahead with this, I think it will be a disaster for a number of reasons. First, it will mean that the provision of our public sector services, health, education, defense, and so on, which is not good at the moment, will go down further. Second, the industrial disruption, which we now have, you can see among you, will, if anything, get worse. And third, it actually, I don't think, will succeed. I don't think that the great British public will agree, for example, to nurses' wages next year being held down to 2% and to the low levels of the present. If I may then comment on one of the things that Fathom was saying, if you divided wages into prices and public, I think you would find that the wage price spiral with respect to private sector wages was already well underway and much more obvious than if you look at wages as a whole. And I think that you actually ought now, because of the attempts by the government to hold down public sector wages, to make that division between private and public sector wages. I'd like to turn to a few comments about the Fathom presentation, almost all of which I quite largely agreed with. First one is, why did central banks get it wrong? I don't think that they got it wrong because they didn't understand that there was a lot of pent-up demand and that a lot of people had quite a lot of bank deposits. And they knew all that. Where I think they got it wrong was because they didn't see the tightening of the labor market that was going to occur when the vaccines were introduced. And actually, Fathom, you should have mentioned vaccines, and you didn't. But anyhow, there we are. They thought, Jay Powell quite clearly thought, and I think the Bank of England also thought, that come the autumn of 2021, there would be a huge flood back of labour, and that would offset the increased demand that would come from the workers who are now back at work and had a lot of money. And I think it was the tightening of the labour market, effectively, as Willem said, that put them off. On the half of Corbyn, I think that it is dangerous to attribute all of that to the unfunded expenditure. It was also due to the frictions that were caused by the particular aspects of LDI and the problems of the pension funds. And I think a lot of the increase in gilt-edged yields initially were due to that. Paul Tucker, I heard Paul Tucker actually arguing on a video conference that all the increase in gilt-edged yields relative to other countries was due to these frictional effects of LDI. And I would be delighted if somebody who was both better and closer to it than me could actually try and distinguish how much of the effect on gilt yields was LDI and how much was sort of underlying concern about the Kwarteng budget and unfunding. I simply don't know. Then again, on productivity, I'm less upset by this productivity decline than most. In my view, quite a lot of it is simply a result of failures of statistics to be able to estimate productivity properly. We have moved from a manufacturing economy increasingly into a service economy, and service output is frequently just estimated as inputs. You know, 3 years ago, I never heard of Zoom. Now I can communicate with people all over the world at the drop of a hat. And that has made my productivity as an academic, which would otherwise be declining sharply, very considerably higher than it otherwise would be. Now, the final comment that I want to make is that in all these discussions, I think there's far too much emphasis on the immediate short run and where peak interest rates are going to go. I very much agree with Andrew and Fathom and against the bank. I just don't think the Bank of England has a leg to stand on to say that you could get inflation down while holding interest rates at 3%. It's crazy. What a model that's based on. Ben Broadbent had an odd model which we published, which I didn't understand a few weeks ago. I'm not sure I believe it. In fact, I'm sure I don't. One of the problems is that we have been moving from a period, as I've written often, of having sort of available labor supply, particularly if you can shift your production to a low-wage economy coming out of your ears, to one in which the labor supply is going to be much shorter. And people are going to be much more worried about reshoring to safeguard your supply chains. And all that is going to push up inflation and fairly sharply. Effectively, what that means is that the natural rate of unemployment is going to go up, and going to go up really quite sharply. And because an increase in the natural rate of unemployment is going to be highly unpopular, I don't think that the bank either will or will want to raise interest rates anything like enough to bring inflation back to 2%. They won't do it, and it won't be done. With the result that, in my view, the idea that we're going to go, as the bank suggests, relatively easily and painlessly once things start turning down and the energy prices start coming down, back to, I'm with Willem. The idea that we're going to go back down to sort of 2% in 2024 and sort of even below that in 2025, it's a mirage. In order to do that, we'd have to have unemployment so much higher for longer. It's just not going to get done. I think that the inevitable projection is going to be a period of stagflation, which isn't going to necessarily be all that horrible. And what's wrong with 3.5% to 4% per annum in inflation and somewhat higher unemployment? We struggle on. It's a lot better than things could be. That's enough.
Charles, thank you very much. Fascinating points there. And now to our next speaker, Dame Deanne Julius, who I'm very fortunate to have as a colleague here in Chatham House. She's a distinguished fellow in the Global Economy and Finance Programme. She's been chair of UCL, she's been chair of Chatham House, and she was also one of the initial members of the Monetary Policy Committee. So, Deanne, over to you.
Thanks for that introduction. And I guess I should also claim that I was at one point an advisor to Fathom when they first got going, advising them partly that it was time to get out of the Bank of England and do something in the private sector. So I'm glad it's worked out. I think just as when we were all on the committee, we did not coordinate our views ahead of time. We waited till we had a good discussion. So it's been interesting for me to hear what Willem and Charles have said. And I think actually we have a little more agreement than I thought we would. I started my preparation for this panel by saying, are we really in an economic crisis? This is an emergency meeting. How much do we feel we're in an emergency? And I think my view is that we, as a country, have had a narrow escape from what could have been a real crisis. That was not just the budget, although that was certainly the trigger or the straw that broke the camel's back, as Laura was saying. But remember, we had a summer of virtually no government at all, at least no effective government. And indeed, it was announced that no big decisions would be taken during that time. So from the market's point of view, this was a period in flux without really knowing what was coming. And that's partly why there was such an extreme reaction when they discovered what was coming, although a lot of it, I think, was simply the facts of what was being proposed there. If anything, we were saved from a real crisis by what is sometimes called the British Constitution, which I've never understood because, of course, we don't have a constitution in this country. But we do have some fairly solid institutions, and we do have a lot of precedent in dealing with these kinds of crises. And this was a case where the chancellor got put by the wayside very quickly. The Bank of England stepped in and put a stop under the gilts market. Pretty soon the prime minister was gone, and then miraculously a new person showed up to be prime minister without another election. So a very shocking chain of events from the point of view, certainly, of the markets that don't reside here in London. But although we didn't have a crisis, in my view, we are still in a post-crisis, very vulnerable situation. We still have very high inflation. The housing market is beginning to wobble. The strikes in the railways and elsewhere are coming up, in fact, tomorrow. And if anything, we have to be extremely careful with policy, including the monetary policy, for the next few months. It strikes me that what the bank produced yesterday in its forecast, I also, like my colleagues who've already spoken and perhaps those who are about to speak, I also found it really unbelievable, particularly the emphasis they put on this constant 3% interest rate. And I think part of what's wrong there is that there was very little very little analysis about what difference it makes to the exchange rate. You know, we heard Jay Powell. We hear that they are going full steam ahead, and they are indeed influencing expectations that interest rates will go up from the 4% where they are now at their cap. Whereas here, our governor is saying they're not going to go up even above 5. I think that's extremely dangerous, vulnerable for sterling. And of course, if sterling does go into a significant slide, then that pushes up inflation, and you're into just the wrong kind of cycle as a monetary policy committee. And of course, external factors are also very uncertain. You know, we don't know how the war in Ukraine is going to play out. We don't know how volatile energy prices and grain prices are going to be. We don't know what the budget's going to look like for the next couple of weeks. But I think despite the level of uncertainty, the direction of travel is pretty clear, that interest rates need to go up, and they probably will need to go up quite significantly. I think I would say between 5 and 6 somewhere, but I wouldn't put any money on it in the sense that who knows. I do think that if you looked at the bank's central projection, by the end of next year, end of 2023, inflation was still 5%, a little above 5%. Would they really not be raising interest rates anymore if they're in a situation like that? Maybe Charles is right and they won't. But I think there's a very good chance in my mind that they would still need to be raising interest rates, even if they pause or take smaller steps immediately. And just to go on with, finally, with sort of the medium term, where do we see this coming in the longer term? I mean, there I think we will see inflation come down over the next 6 months. It's almost assured because of the base effects coming through. But given the uncertainties in the geopolitical environment, including the US election and how things go there, I think inflation is going to be pretty volatile because energy prices will be volatile, and these second round effects will be volatile. So I think that it will be the case that the bank really needs to look more at core measures of inflation and make sure that it is targeting the right thing and not simply the volatile headline rate. I also felt that it's important to think about some of those underlying cost pressures that come from what Willem was talking about, for example, the geopolitical tensions, the fact that it's going to be difficult to get semiconductors in various countries, and that's a key input to many of the things that we consume, inventory building for resilience. All these things add to costs of industry. Even if Charles didn't mention it, I was very struck by his demographic discussion in the latest book about China and what's happening there. So that the global supply of labor of effective labor is certainly going down, and that, of course, will push inflation up. So it seems to me that in addition, we've got on the investment side of the equation, big demand for some of the energy transition investments. There's demand for additional military spending in a number of our countries. So looking at the savings investment balance leads me to conclude that real rates, natural rates, are likely to go up, not down. And I did, just as a matter of comparison, look back at the time when all of us were on the MPC. The normal range of interest rates during that time was 4 to 6%. And at the same time, inflation was a little bit below 2%. And the economy was growing reasonably well, certainly well compared to today's looking back. So it seems to me the era of ultra cheap money is over, whether because of the reasons that Fathom has come up with, or that Charles has talked about, or that we all are recognizing when we read the newspapers every day about Ukraine. I think we have to get away from this zombification, if that's a real word, and get away from the asset price bubbles that have held back growth. Thank you.
Dan, thank you very much. And now for our final introduction from Sushil Wadhwani. So Sushil is currently the Chief Investment Officer of PGIM Wadhwani. He was also a member of the Monetary Policy Committee, not quite from the start, I think, but pretty close to the start, 1999 to 2002. He's worked in Goldman Sachs, Tudor Investments, as well as having a number of academic roles and appointments. And Sushil, I don't know if in the course of your discussion you were able to answer Charles's question about, how much of what we saw in terms of yields and so on was due to actually market failure rather than expectations, because you are probably better placed than anybody to answer that question.
I'll make an attempt.
Thanks. Sushil, over to you.
It's an inexact science. But thank you very much. It's a privilege to be here. It's also a privilege to be reunited with these three. We were the infamous gang of four. So it's great to be together. Now, I knew I was going last, and therefore I knew that many of the things I wanted to say would be said by these very clever people. And I also knew that they would be giving the bank a hard time. So I'm going to first start by saying one or two nice things about them, and then go on to other things. So, I mean, obviously everyone acknowledges it's a very challenging environment. It's really, really tricky. I remember Rachel telling me 20 years ago, maybe, or yes, around 20 years ago, that actually any assessment of the inflation targeting regime could only reasonably be made once the economy faced a challenging environment, and that what we then thought was a challenging environment was nothing compared to what might happen. And you were completely right, as always. And I think the second thing is a lot of people, and we saw that in the poll results earlier, say that they would have raised rates earlier, they would have unwound QT earlier. I was certainly in that camp last year in public, but if I'm truthful to myself, I would have probably raised rates a little bit, unwound QT a little bit. Inflation might have ended up at 7 or 8 rather than 10. But for the great British public, it would have still been a dismal failure. I mean, 7 or 8 versus 10, who cares? You failed. Now, having defended them, I have to say that, I mean, I look at them, they're very clever people, they're very nice people, they're very knowledgeable, and but I'm really puzzled by some of the things they're doing and saying. And I sometimes wonder whether I'm just too old, and that's why I don't understand why they're doing what they're doing. But as Fathom have said, I mean, the second round effects are just, at least to someone like me, just seem completely obvious. And they're obvious even in their own decision maker panel survey that they run themselves or they help run themselves. You just look at those numbers. These are not firms whose inflation expectations are on any definition anchored. If you look at their inflation expectations over the next few years, even 3 years out, they're very high. Their acknowledgement that they're willing to accommodate high wage increases is apparent in that survey. And yet, for some reason, they don't place enough weight on evidence of that kind. Here I will be repetitive, but I was just really, really puzzled by yesterday. So on the one hand, they did the right thing and put rates up by 75 basis points. And I would have thought in terms of their impact on people's expectations out there, they largely unwound it then by talking about how rates possibly may not need to go up very much more. Maybe 3% was it. It just seemed pointless. I mean, you've just put them up by 75 beeps. At least don't undo any benefit that you might get from that. And the notion that anyone can be confident in terms of knowing where rates are going, I mean, I just find that fanciful. If you think about how wrong the consensus has been, how wrong the bank has been in terms of where rates would be now, it's just really, really odd to me that anyone could have confidence. I'm supposed to stake my clients' money on betting on interest rates, but I really just take each day as it comes. I don't sit here thinking I know it's going to be 5% or 6%. Really, one just has to respond to the data. And I mean, my sort of simple advice to the bank would be, they should just copy what Chairman Powell Mark II is doing, rather than Mark I, obviously. But Chairman Powell Mark II has kept it really simple. All he says is that he's determined to bring inflation down. He knows that if he doesn't bring inflation down, it's going to be damaging, and he'll do what it takes. And he doesn't know what that means, but monetary policy will respond to the data, and he'll do what's necessary. And that's a much, much simpler and a much more credible message than we're getting from the bank. Anyway, the other thing that really puzzled me was a remark from the deputy governor, one of the deputy governors yesterday at the press conference, where he said that it was the duty of markets to listen to what they said rather than for him to pay any attention to what the markets thought. I mean, I just found that unbelievable. When I was in the MPC, I always felt that I actually knew remarkably little, and that it was really important to learn from other people. And I'm old-fashioned enough to believe in the wisdom of crowds type of argument and think that there might just be that little bit of information in markets. Now, having said that, obviously I've tried to make a living out of the excessive volatility in markets, and I recognize that they can and do get it wrong. But having said that, to then go to the other extreme and dismiss all information from the markets struck me as incredibly dangerous. To think that we have a deputy governor who thinks like that, I found profoundly worrying. The other thing which I wanted to raise, I know I'm about to run out of time. My two last points are another thing that they really puzzled me with is their attitude on QT. And this was reiterated at yesterday's press conference. So they said yesterday that actually none of us should worry about QT. It doesn't really matter. And it doesn't matter because they're not trying to send a signal by doing it in terms of future rates. And the second reason, which I found absolutely extraordinary given what's happened in the last 8 weeks, is that QE only matters when market conditions are difficult. And since presumably market conditions are great now, QT doesn't matter. It was absolutely extraordinary. And my last point, sorry, Creon, is I was surprised, I have to say, Charles. You were my mentor when I was first appointed to the academic staff at the LSE. You were my official mentor. You may have forgotten that. But I was very surprised to hear you say that it's kind of okay to let inflation drift up, because obviously that's the thin end of the wedge. One's hearing this argument everywhere. Jason Furman raised it at Jackson Hole. A lot of other people are bringing it up. It seems to me this is incredibly dangerous. But I'll just stop there.
That's a good point. Brilliant. So we are a little bit behind, but we will catch up. No worries. What we'd like to do now just is have another poll. If we could get the poll question up. And this time I was rushing things, so I will be more bit slower in allowing people to put their questions up. And I think you can also respond here online, and also people can respond. So I think we're waiting for the next one. Yeah, here it comes. So if everybody would like to respond to that. I'm hoping that's the question we're expecting. Yeah. I'm not quite sure what everybody can see online, but maybe the same thing as I can see. Okay. So that's very interesting, because I know that's not what Eric thinks. So we might come back to that shortly, but there seems to be quite a strong...
You should pay more attention to me.
Exactly. Now, I have a vast number of questions, but I know that there are other people in the audience who probably have much better questions than me, so I'm going to restrain myself, at least to the end, and gather some questions from the audience, but also invite our online audience to start putting their questions in, and magically I should be able to pick some up from here as well. But let's start with the audience here, and if we could kick off perhaps with 2 or 3. So the gentleman over there, first of all. Thank you.
Hi, Ed Conway from Sky News. Thank you. It's really nice to be doing these things again, and thank you very much to Fathom for putting it on. I'm getting quite nostalgic about those days when interest rates didn't change. One of the striking things, obviously, about the meeting was, as pretty much every panellist has alluded to, was that attempt to try and influence the market. And obviously, then it was striking to see that the market listened to that and were like, well, we don't really buy that, and it didn't happen. I just wondered, how much do you think that was strategy from the bank? How much do you think it's delusion in terms of having a kind of forecast or indeed a kind of idea that interest rates at that level are going to be okay? So how much of that is strategy versus delusion? Going to kind of to Charles's point about whether stagflation is kind of what they're seeing us heading towards. And secondly, just how much does it matter if you have a loss of credibility, which it feels like maybe we're in that kind of realms where the market and pretty much everyone on the panel has a completely different viewpoint to what the bank does on interest rates. How much of a big deal is that in the future when it comes to policy, when it comes to the economy and where we're heading?
Thanks very much. If we could just add, I'm sure there are other questions in the audience, so does anybody else want to pose a question alongside that one? Yes, Bronwyn, if you'd like to. If we bring the mic forward, and just there should be a mic coming your way. This one here, please, if we could just go to this one first, thanks. And just to say, I know who you are.
Bronwyn Curtis.
Yeah.
But I'm on the oversight board of the OBR, actually, among other things. I want to ask Sushil a question about the markets, because one of the things that happened was credit spreads jumped, and no one's talked about the yield curve as a whole. And I wondered if what you thought about that. I mean, I'm not surprised, but should we be looking, or should the bank be looking more at the overall tightening in the market? Because credit spreads really jumped a lot.
Excellent. So let's take those 2 questions and that one together. And who would like to go first? Sushil, why don't you go first, and then we'll.
Okay, so I'll start with Ed's questions. I mean, I think their loss of credibility matters hugely. So certainly when we were all at the bank, we used to think it was, really convenient to have an extra sort of tool. So you moved your rate, and then you did, in some subtle way perhaps, try and influence expectations. And it was incredibly helpful to have that auxiliary tool. Therefore, it was really surprising to me that they were willing to allow those 2 things to operate in an opposite direction yesterday. But credibility also matters for many other reasons. So, when big events happen, big shocks happen, the fact that people have typically believed the bank really matters. And you saw that in a small way in the recent gilts crisis, where they hardly had to spend anything. So it's a very, very precious asset. And it's sad to see them kind of sort of beginning to lose it.
But in the response to the question of, is it that they know that this is not fully in line with what the mandate would say, what you should be doing if you actually have a 2% target in line, versus, and therefore they're just because they're worried about the consequences for cost of living and that kind of thing, versus the fact that they have a different analysis to the members of this group here. Because I think that was the question that was being asked, which of these 2 things is it, do you think, in your view? Is it that they actually know what they should be doing, but I just don't think that the public could accept this at the moment? Or is it that they actually have a different model of how things are going to work?
Well, I've got to believe it's a different model because,
Yeah.
I mean, at least the individuals I know are sincere,
Absolutely.
hardworking,
Yeah.
honest people.
Yeah.
And it would be outrageous for me to cast aspersions on their degree of honesty.
Yeah. Okay. Fair enough. Okay.
and-
Anybody else like? Sorry.
Yes,
Sorry. And
yes.
do you want to go to Bronwyn's question as well? Very quickly.
So I want
Yeah.
to make sure. Yeah.
Credit spreads.
Credit spreads.
Yes.
Yeah.
Credit spreads as well.
I mean, I assume they do look at credit spreads, and I would be very surprised if they didn't. So, I mean, certainly in our MPC chart pack, I mean, I've been off the committee 20 years, so my memory isn't as good as it should be. But from what I recall, we were, it was very much in the chart pack, and we did focus on it. But it's possible, because you also talked about across the yield curve, and that sort of, that reminded me that I didn't answer Charles's question to me about LDI and everything. So I think the LDI shock clearly was a very large part of what happened to 30-year gilt spreads versus, say, the US. And that is very much where the shock was concentrated, in the 30-year area. For what it's worth, the many UK pension funds and consultants I've spoken to since the shock, I mean, my 2 penny worth would be that they've all adjusted very, very meaningfully now, and they're no longer a source of a future shock. I mean, in terms of what actions they've taken in terms of rebuilding liquidity, and the actions that they've taken in terms of reducing their hedge ratio, which has been very meaningful. And in some cases, as you saw with Sainsbury's yesterday, the parent company has arranged a cash infusion as well. So if you put all that together, I don't see them as being a material source of risk to the gilts market, unless yields go up another 200 basis points or so.
Great.
At that level, I think they could become another source of risk yet again. But your question was across the yield curve, and we did, of course, see a big UK fiscal risk premium at the short end as well, which I believe had nothing to do with the unraveling of LDI, except to the extent there was a little bit of contagion. But it was only limited. So I think there was a risk premium which built up there, more because of Charles's argument that sterling was highly vulnerable, and that you could get a sterling collapse because of poor fiscal policy, and then that would then force the bank into hiking rates. So
Sure.
Sorry.
Thanks very much. Maybe
I went on too long.
Not at all. No,
Sorry.
it's all excellent stuff. I'll go on to Deanne next.
Yeah,
Thank you.
I wanted to just say something about the credibility point. I absolutely agree, credibility is very important, particularly I think in these economic times when the vast majority of the public, I hope they'll tune into this new broadcast about the basics of what does GDP mean and how does inflation happen. Because I remember when we first started on this journey, we used to mention 2.5%, it was 2.5 in those days, 2.5% in every third sentence, when we would go out and speak in the regions and so forth. And the idea was very explicitly to get that anchor into people's minds in a number that they could kind of remember, and against a measure, the CPI or the RPI in those days, that they'd all heard of. And I think that was very important for domestic credibility. Now I think the real difficulty that the bank has with credibility is that too much of their communication is based on the forecast model. Most people do not, including most of us, I think in this room probably, do not really understand how the forecast model works. I think the members of the committee do, and it's changed over time. But the difficulty is getting through this idea that this is, I think they don't call it a forecast, it's a projection. That it is based on assumptions, and if those assumptions are right, then probably the outcome is right. But the assumptions aren't right. They're never right. They can't be right. And that is too complicated a message for most of the media, certainly, so that the message becomes, a 2-year recession, because interest rates have gone up to 3%. And although I don't know what the alternative is, I think even the US case, where they just have this dot plot, which I'm glad we didn't have to do that ourselves, but that is maybe a better communication device than the forecast model is. I'm not saying they shouldn't have a model. They should certainly use it in the discussion, but I think to make that the main element of communication has really been a disaster.
What I'd like to do, actually, because we've got great questions coming on board, so if others could hold their fire for a minute, and we'll take some of these questions now. So one of the questions is, can you say what the bank should be doing on the pace of QT and whether targeting shorter dated instruments makes sense? And that's from Matthew Elderfield. So a question about QT. Another question which kind of goes a little bit to some of the points that Sushil was making. Had the Bank of England raised rates to 3% prior to the Truss budget, to what extent would the market reaction have been different? So if they'd moved earlier, in a sense, faster. And then the final question, if we just take this, is a question really about the redistributional effects of the inevitable kind of rise in interest rates on the average person in the country. I mean, how bad, in a sense, is it going to be as a consequence of the levels of interest rates we're going to need to address inflation? And I guess the implicit question then is, in a sense, it's not the bank's job to address those questions, it's really for the government to respond to what the bank may need to do, in principle. So those are 3 questions, and I wonder if I could come to, actually, William, first of all, online, whether you would like to pick up on any one of those questions, or all of them, potentially, but as briefly as you're able to do so.
Thank you. On quantitative tightening, I already mentioned that the 80 billion annual target is de minimis. I think at that rate, it would take 10 years to get rid of the portfolio that was built up since the great financial crisis. And I think we're going to have to move in a market-sensitive way, right, as quickly as possible, always having an eye on possible market disruptions and being willing to intervene, as the bank did appropriately during the kerfuffle between the 28th of September and the 14th of October. As regards to the redistributional effects of rate hikes, well, they're there. We all know about them. Borrowers get hit. Lenders, savers are smiling. If this is a problem socially, then the government should address it through the budget. The bank cannot let itself be influenced by these considerations in terms of the speed or the magnitude of its rate hikes. Let me just, one quick remark on the earlier thing, whether it was sort of strategy or delusion that caused the bank to come up with this 3% projection. I think it is strategy driven by delusion. It really is the wrong model. Yes, it's very hard to predict what interest rates will be, and I can't be sure either. But I am really pretty sure that rates stuck at 3% will not give us below target inflation by 2025. And so it is the wrong model. And this undermines credibility. And if you add to that the statement that markets should listen to the bank rather than bank listening to the market, I think you really are undermining the future effectiveness of monetary policy. They have to be aware, they have to believe that you will do whatever it takes to get inflation back to the target. You may not know what it is, but just as the bank during the uproar in the markets, said that it intervened in any amount necessary to restore stability before they set the 65 billion limit, which was simply, I think, a short-term target. It is absolutely essential that the markets believe that they are serious about achieving the inflation target within a reasonable time horizon. Thank you.
Thank you very much. Charles, is there any of those 3 points that you'd like to
I'd just like to comment on Willem. It is awfully easy to talk about being determined to get back to your inflation target when unemployment is at an all-time low. Just wait until unemployment starts rising, say 1%, 2%, 3%. It'll be much, much harder to go on saying I'm determined to get it down to 2% and I'm going to raise interest rates come what may. Just think of the kind of political flack that you will get from doing that.
But doesn't that make it doubly important that they say it now?
Yeah, and one of the things is when the underlying situation is inflationary, you've got to raise interest rates early on and by a lot, because you won't have much chance to raise them later, because the political context will be against you. Exactly. And that has been the error that the Bank of England has made. It has waited and waited and waited until it is too damn late.
Given where we are now,
medium-term inflation expectations
75 basis points yesterday.
No, because the clear comment was made by the chief economist there that you've got to raise interest rates a lot was when we had the Kwarteng mini budget. When we got the change of government and the new chancellor and the suggestion that we're going to have a properly funded fiscal policy, I think the 1% or more had to be taken off the table. And if they tried to go 1% or more, it would have been almost a statement that we don't believe that the Sunak Hunt will actually do it. And I don't think they were in a position to make that statement.
Okay. Sorry, Willem, you were you trying to? No. Okay. Great. Well, let's get another set of questions. There's a gentleman here and a gentleman in the front here, and then a gentleman. But it'd be nice to have some ladies as well. If you wanted to put your questions, are extremely welcome. But we'll take the gentleman here first.
Michiel Remmers, a member of Chatham House. On the confidence in the Bank of England, although everyone watching screens all days, of which I'm one of the people, may have all kind of views on this, the five-year forward inflation swap hasn't really moved in the US that much, or isn't that worrisome still. So remarkably, markets seem okay with what is discounted now. Is that maybe because some of the data is actually not as bad as what we've presented before? Is it, if we look at Baltic freight, if we look at shipping rates, I mean, in my role, I cover a very big shipping family, privately owned, who predict that container rates will be below the average of 2018-19 next year. Simply because their competitors have expanded capacity with all these higher rates that were there, and demand is considerably low. Walmart said that for this Christmas period, they've ordered considerably less. Target is ordering considerably less. David Roach, an independent analyst, has stopped tracking the queues at ports because there aren't many anymore, and the supply chains come back.
Yeah, so your point is that global deflationary pressures may save us? Yeah. Potentially, yes. Question here.
John Geeve, ex-MPC for a few years. I wondered, I was trying to think, well, you know, what would the Bank of England be saying to the panel about their forecast? And I guess they'd probably say that they were taking a different view of the labour market, that they thought that wages were going to be squeezed in real terms really savagely, and that alone would produce the sort of deflation and recession that will bring inflation down. Whereas I think your view is that's not going to happen unless the bank puts up interest rates a lot more aggressively. So you might want to comment on that. One other thing on the wage front, I think it's going to be a critical part of the fiscal statement, what is assumed about public sector pay. I suspect that they will take the view that they can't let public sector pay increase within existing expenditure budgets, and that therefore they've got to have a squeeze, a freeze, rather than taking the view that they've got to top up public sector programs in order to allow for a higher rate of pay increase. What would you be advising them on that?
Thanks very much. And then one question here, very quick one, and then another question there.
Yes, thank you. My name is Yasune Kano, a visiting fellow at Chatham House, originally from Japan. My question is about a spillover effect or pressure to and from the monetary policy of other countries. Well, so how did you see the balance between focusing on domestic inflation and the gap of interest rates with other major economies such as European continent, Japan, and the US? Well, Japan, for example, is facing low inflation now domestically, but facing, big increasing gap of interest rates with other economies. Traditionally, inflation was country-specific issue, but in this case, you could see some danger of seeing that in a simple way. Thank you.
So is your point really that the interest rate gap will lead to exchange rate depreciation and
Even if
yeah?
the domestic inflation is low.
Okay. And lady here as well.
Hi, Joanna Davies from Fathom Consulting. Something we've been thinking about internally lately is what's the one thing we would do differently with macro policy? Deanne, I feel like you hinted at that earlier in one of your other responses. It sounded like you were suggesting a communication difference, something more similar to the US Fed perhaps. But one idea from each of you would be wonderful on that front. Thank you.
That's a powerful question. So, Andrew, you shouldn't answer the Fathom question, obviously, but I don't know if you want to comment on the other questions.
So there's quite a few. Let me just try and quickly remind myself of them. So I think Sir John was talking about real wages falling, and perhaps that's the Bank of England's hope that that it will squeeze out wage pressures and inflation will come back to target. I think there's been a lot of focus on the fact that real wages are falling, which of course they are. They're falling quite significantly. But as I think Eric and Laura were trying to set out in the presentation, I still think even though real wages are falling, nominal wage inflation is inconsistent with the inflation target, and that for me is part of the second round effect. If we were in a situation where real wages were flat, so wage inflation was exactly the same as consumer price inflation, then in that kind of world, inflation can almost become a random walk. That's kind of extreme second round effect. So we're not in that bad a world. We were in that world in the 70s, I would say, for a brief period of time where inflation was, your best guess of where it would be next year was the 23% it was currently at. So, it's good that, it's not good, it's good for inflation that real wages are falling. But I still think that nominal wage inflation is a problem because it's not consistent with the target. And I think that we've done quite a lot of work looking at it. There's an interesting nonlinearity which we try to get across in the presentation, that when inflation is low, sort of less than 4, then the correlation between inflation and wage inflation is pretty much 0. Inflation might be 3% this year rather than 2, and an employer might say, well, sorry, you're only getting 2% because it'll be 2% next year, and the worker might go, all right then, I'll believe that. But when it's 10%, they say, well, no, it's going to be 2% next year, that's all you're getting. Well, no, I don't quite buy that now. And so I think there's a point at which inflation really matters for wage inflation, and the spirals start to build up. And I think in the private sector, someone was saying earlier, it's important to make a distinction between the two. I think, Charles, and of course it is. There is a wage price spiral in the private sector, not in the public sector yet. And then to answer your question, I think again about what would we be saying if I was in government? What would I do? I guess I think it's right to listen to the pay review bodies and do what they say, and they will probably say to put wages up quite a bit, and I would do that, and I would let the Bank of England deal with the inflation consequences, probably.
Right. Shall we, since we're very close to the end, I'll probably have to make this our final set of responses. So I don't know if there's anything more broadly you want to say, just generally, because I think we'll answer these questions, and also just any general points. So.
No, I'll let the others speak.
Okay, fair enough. Sushil, any of those questions you'd like to pick on, particularly global inflation pressures? Is there a chance, deflationary pressures, is that going to help?
Yes. So I think that what was being said about shipping rates and so on resonates with me. I mean, it's clear that there are significant components in headline inflation that are going to sort of come off and go in the other direction next year. So I have no problem with headline inflation falling very considerably in many countries next year. The reason I remain worried, though, is that I think core inflation in the US and the UK will not fall enough, will not fall anywhere near target, and that a lot more work will have to be done by monetary policy authorities in both cases. I don't know how much work, but a lot more than holding rates where they are. And I personally, look at break-even inflation, but if I'm trying to work out what's actually going to happen to inflation, my favorite expectation measures are what firms are saying. And I mean, consumers, I'm not even sure they understand the question. With firms, I find that much more reliable than any market-based measure.
Interesting. Very good. And did you want to respond to John's points about the...
Andrew responded very well for me.
Okay, very good. Yeah. Excellent. Charles, any comments on those?
I think that the public sector wages point is very critical. And private sector wages are rising, my understanding is about 6% per annum. And given what's happening in the still very tight labour markets, I don't see them coming down much next year. We've already got a virtually historically high differential between private and public sector wages. And to go pushing this yet another year, I think will lead to some kind of effectively explosion. And I think will be deleterious in virtually every way. I have to say that I would definitely advise the government not to allow public sector wages to fall that much further behind private sector wages, e.g. at least 5% per annum for 5% next year, and find the measures to finance the deficit through other means. And if that means higher taxation, so be it. And one of the things I would very much like to see is that I think the government should say now that when energy prices come down, as they will, the market prices, that the prices that the consumer pays will not come down that much, because they will raise taxes in order to effectively keep the budget deficit down and keep prices or the consumer pays high, so that there's a market incentive for everybody to economize on carbon.
Can I just ask you in that, I mean, one of the things that this inflation shock is going to help us with is our debt-GDP ratio 2-3 years out is going to be a lot better than it might otherwise have been, simply because of the inflation shock.
Yeah, but think what happens when we reverse it.
Yeah.
When we reverse it through high interest rates and get the inflation down, then all the benefit will go wildly in the other direction.
Yeah. Okay, thank you very much. Deanne?
Quickly, I actually disagree with that about public sector wages. I think that the public sector ought to be setting an example. The government needs to set an example there. I guess I would also stress that public sector employees have a fantastic pension that most of the rest of the country doesn't have, and that's actually worth a lot when it's calculated. So I might go somewhere between whatever the public sector, the pay groups say, and 2%. But I think it's important to keep the lid on that. I also am not sure, although the rate of increase has been higher in the private than the public sector, the last data I remember seeing, it was still at the absolute level of wages was, average level, was higher in the public than in the private. But then there are mix effects, and so I'd have to look at the data on that. I think I just pick up a couple of quick things on the pace of QT. I think as fast as possible, as Willem said, is the answer to that. It is right, in my view, certainly to go with the short gilts first and to think about the interest rate element of that, and maybe even look at the tiered reserve situation, which I think Charlie has mentioned and Paul Tucker has written an interesting paper on. And on the Japanese question, although I'm a great fan of Japanese gardens and I have bonsai myself, I've never understood the Japanese economic situation. I think it is somewhat sui generis. It's a huge economy, but it has had a long period of deflation. I think there is a lot of path dependency in inflation or deflation in this case. So it's hard for me to say whether they will need to move interest rates in line with other countries. I think that's not the case in the UK. We really do have to look at comparative interest rates here, thinking about what effect it might have on sterling.
Incredibly loyal domestic investors in Japan, very much so. Willem, any reactions to those questions or other final point you want to make?
Just that headline inflation will be benefiting from base effects of energy prices and shipping costs, just as headline inflation was upside distorted early in about a year ago from base effects, the other way around. But we should not underestimate, I think, the likely persistence of above target, broadly based inflation, both in the markets for goods and services and in the labor market. And so I think that as regards public sector wages, they should be part of the package of fiscal tightening that this government is supposed to deliver. Whether I would prefer to do it through higher taxes or other public spending cuts elsewhere or below inflation increases in payments, I don't know. I think that it should really depend on the specifics of the individual subsector in the economy. I don't think a uniform policy is necessarily required here. But it's going to be painful. And there's no way to get rid of inflation except through a period of hopefully not too prolonged pain, but it's certainly a couple of years of pain.
Well,
thank you.
Unfortunately, I'm afraid we've come to the conclusion. Firstly, let me thank Fathom for bringing this idea and for a brilliant opening forecast. Thank you very much, Eric, and the whole team that's here. Can I also thank our brilliant panelists, both online and in the audience, and in the room here. Really stimulating responses, and but lots of questions still to answer, including the question about sort of new kinds of macroeconomic policy. We'll have to come back to the future. And then finally, if I could thank the audience online for a whole bunch of questions still coming in, actually, and the audience here for your participation and your questions as well. Thank you very much. So thanks to everyone.